side, you might see 103 as an immediate next resistance.
All right, Manisha, thank you so much for joining us live on the show with your thoughts on commodities. Let's also put the spotlight on Havells, another stock in focus today. The company has formed an important JV with Chinese company Yaming to manufacture electrical products. The JV is likely to invest about $50 million to start off with. That's what the company's management is told. We'll try and get the management of Havells on air in just a bit. But as you can see, the stock is up almost 3.5% in trade today on the back of that announcement coming in of that Chinese JV. We'll try and get a word in from Anil Gupta, Joint Managing Director of Havells India, on what really are the growth projections for this particular JV. Aisha?
In fact, the stock is holding up and not bad in the volume picture as well. 400 thereabouts is where the stock is currently nudging in trade. Some more details on the joint venture that we were just talking about. It's with China's Yaming, and the joint venture is to manufacture electrical products, including lighting products. Remember, Havells already has an R&D set up currently in China, so they are looking at banking at their presence in China already. Havells and Yaming will have an equal shareholding in the joint venture, which is going to be a 50-50 joint venture. In fact, let's listen in from the management themselves.
Well, we are setting up a manufacturing joint venture with Shanghai Yaming for manufacturing of HID lamps, LEDs, CFLs and lighting fixtures. And this is a 50-50 joint venture. And the manufacturing setup will be done in Jiangsu, which is near Shanghai. And we hope to start commercial production in the third quarter of the next financial year.
What about the investments, and what are the benefits you're going to have from this deal?
Well, we are the initial planned investment is about $50 million, and we hope to get a production base for our global markets as well as for the Chinese market. And the expected turnover in the next 2 to 3 years can be about $100 million from these product categories. The basic idea is to have our own manufacturing setup where we can control technology rather than getting it manufactured from other sourcing partners, and for the global markets of Slovenia.
How's the European market playing out for you? Is there a slowdown you're seeing, and is there a slowdown for Slovenia or you both in European markets?
Well, as you know that 70% of Slovenia's turnover comes from the European markets, and there has been a slowdown, but not for Slovenia. We have invested a lot in building our infrastructure as well as our brand capabilities. So we've not seen a slowdown. In fact, we've maintained sales, but we have definitely expanded our margins this year, making Europe from a loss-making country or a region to a highly profitable region this year for us.
How is the currency fluctuation affecting the company, and if are you affected by the company, what are the possible solutions for that from your side?
Well, definitely the cost for any imports increases in India, and we are taking corrective measures by enhancing prices or controlling our expenses. We definitely want to maintain our margins, and till now we have been successful. So currency has affected us in terms of increasing costs, but we are able to overall maintain the margins.
Are your plants running at full capacity, and if yes, so any plans to increase the production from the plants?
Well, in the last couple of years, we've invested close to about 400 crores in capex, and that in basically enhancing capacity in all our product categories. So that's the reason that today our plants are not running at full capacity, and we can continue to grow at a pace of 25% for the next 2 years, and still from these existing plants also.
What are the debts on your books, and how do you plan to deleverage that?
In India, we do not have any major debt, but for the Slovenia acquisition, we had taken a debt of close to about 120 million euros, and that is going to be refinanced in April 2012, and we hope to get another 5 or 6 year term for that. So debt is not really a problem. The cash flows are quite strong to meet the debt requirements.
Okay, that's Havells holding up to the tune of about 3.5% on account of the joint venture currently called on in China. Meantime, let's get back to the markets, and let's get you some more perspective in terms of how 2012 is likely to kickstart. Jigar Shah, Senior VP and Head of Research at Kimeng Securities.